Welcome everyone to another Meet Kevin report. Stand by 1 second while I press all the correct buttons because I haven't done so yet. But as soon as I press all the right buttons, we will be ready to go. 1 second here. And welcome back officially to another Meet Kevin report. It is episode 121 and July 13th. Today we are getting PPI data. We are also starting and kicking off earnings season. Well, it is really starting in earnest now, given that we just got Delta earnings, which we're going to be talking about in just in a moment here. In addition to that, we're getting bank earnings in the next 24 hours, and we're getting PPI inflation data. That's producer price inflation data, a nice leading indicator for what could end up happening with CPI. So one of the last things that we want to see is any kind of reversal in PPI data today, because then we might just undo all of the enthusiasm that people have had. But first, let's jump into Bob Iger because he's finally talking on CNBC.
Enthusiastic about it.
Why are you enthusiastic about it?
Because I think sports stands tall in a sea of tremendous choice.
There we go. I forgot to unmute Twitter Spaces. My bad. Welcome back to Meet Kevin Report 122. Let's listen into Bob Iger, see if he's got anything interesting to say before we get to PPI and Delta earnings.
Position in it, we feel that we should stay in it, but we'd like to.
You're spending more and more money to do that. I mean, to keep the NBA, to keep the NFL, essentially renting the content that keeps this thing alive. I mean, is that the best use for your capital?
Well, I know a lot's been said about renting versus owning, and if you can rent it and continue to be profitable from renting it, which we have been and we believe we will continue to be, then there's real value in staying in it. We have great relationships with Major League Baseball and the National Hockey League and various college conferences, and of course the NFL and the NBA, and it's not just about the live sports coverage, of those leagues, those teams.
All right, let me go ahead and give us a little bit of a summary of what we've got so far with Bob Iger here. So he started speaking just a couple of minutes ago. He says there's a lot more work to do with getting the company on track at Disney. He says he's quite pleased with how much he's accomplished since he's returned to his CEO role, and he's extremely optimistic, but he says the challenges are much greater than he expected. And with a lot of work to do, including more cost reduction at Disney. He says we're going to be expansive in examining different parts of the business, as well as potentially selling various different TV assets off. Sports stands very, very tall in the media landscape. We just saw him say he's enthusiastic about potentially taking ESPN direct to consumers. And Disney stock ultimately is potentially climbing slightly as he has officially been confirmed to remain as CEO, which it would certainly be quite embarrassing if he already got kicked out as CEO this early at Disney. Of course, this is the second time in as he's come back from retirement, but he hasn't been back that long. So anyway, now that he's been renewed, it seems like there's some optimism. Although the entire stock market feels somewhat optimistic now following yesterday's CPI data. I'm going to pay attention to Bob here to see if there's more excitement coming from some of the Disney reporting. When it comes to Disney from a fundamental basis, the concerns that I have is you've got a return on invested capital at this company that's really fallen off a cliff. It used to be a lot higher than it is, and it really feels like the heydays almost, it's sad to say, of Disney are somewhat behind us. Obviously, you have a lot of political complaints with some folks complaining that potentially Disney has gone too woke. And of course, the right says when a business goes woke, it goes broke. I personally just look at the balance sheet and I'm like, in my opinion, y'all got way too much debt for me. It's unfortunate. But again, remember what I tweeted just a couple days ago, and I've mentioned this a few times just because I find it so shocking, is that 8 years ago this week, you could have invested $100 in Disney and been left with $76 today. That's 8 years of investing to have a negative 24% return. People get mad about changing minds about stocks, but you have to be careful. Some stocks just unfortunately end up trending down rather than up. And that could be as business models change, or really as businesses mature to an older stage of growth, where growth goes away and any kind of premium there is to pay for a company really starts wandering down. So I'll keep an eye on any other news that comes from Bob. But it looks like this is going to be a longer sit-down exclusive interview here with Bob Iger, and we've got news to cover. So the first piece of news before we get into PPI is, of course, Delta earnings. Let's review what's going on with Delta earnings and what kind of potential leading indicator this could have for the economy. Keep in mind, myself and many of us in the courses on building your wealth, we've been watching inflation through earnings in the last really year. And one of the things that we've noticed is this massive inflection point. It's more than a year, actually. It's more like 18 months. We noticed and I want you to pay attention to this when it comes to earnings. So I'm saying it before we get to Disney earnings on purpose, Delta earnings here on purpose. In Q1 2022, January, we noticed massive inflation. Every single company was bragging about having pricing power. And I'm like, look, if everybody's saying they got a massive PP, not everybody's got a massive PP. Like, massive PP comes from massive brand value and people's willingness to buy a product in almost any circumstances, no matter how hard. That was the case in January 2022. Everybody was buying everything still, and inflation was very, very rampant. Over the last 6 months, we've seen that almost evaporate. Breaking down Q4, Q1 earnings, for example, given that Q2 we're just now starting, breaking down Q4 and Q1 by going through the actual fundamentals and looking at what companies are doing with their cash, with their debt, with their inventories, with their revenues, with their net income, and what they're saying about inflation in earnings calls is a really, really good, in my opinion, leading indicator of what's happening with inflation. And everything that we've been reading over the past 6 months has made it very clear that the CPI numbers we got yesterday are what we would expect. That's because earnings are really good at forecasting this kind of stuff, in my opinion. So anyway, as a result, we're going to look at Delta. I just want you to be aware that the more we look at these companies, the more insight we broadly glean. And it's not going to be one company here or there that generally helps. It's that broad, that sort of average, that collective movement of everything. So with that said, let's take a quick look here at Delta. So the first thing that I always like to do when I do these earnings, at least what we do when we do these earnings with course members, is we go straight to balance sheets, cash flow statements, and of course the income statement before we get to any kind of commentary. So cash flows at Delta have more than 2x over here. You can see we're at about 1.8 billion in net income rather. Cash flows themselves are slightly up. We can see that here. Net cash provided by operating activity. So our net income, rather, let me state this correctly, is up about 2x and a bit. We've got a little bit of a decline here in air traffic liability. In my opinion, this is a sign of potentially Delta becoming a little bit more organized with their cash, to where they're able to catch up on some of their bills payable. Air traffic liability is usually when you go land at an airport, you have to pay landing fees and support service fees. So those are not just the landing fees, but then of course you have cleaning fees, you have fuel dump fees, fuel fill fees, toilet dump fees rather, and all the other support services you get from an airport oftentimes get thrown together under air traffic liability. You've got change in profit sharing. Big, massive increase over here. What else do we have? Let's look at net cash from investing. We've got plant, property, and equipment sitting somewhere around 1.4 billion. So many more investments coming in here from the airline industry. And this might be one of the reasons we actually have a bit of a leading indicator of not necessarily for inflation of general aviation inflation, but what you generally find, in my opinion, is when you have the airlines spending massive amounts of money on more planes, you're in a really great situation potentially for aerospace companies. Those are going to be your Boeings, your Airbus, your Embraer, mostly because if there's one place that still has inflation, in my opinion, it's aerospace. That is a place where you're still fraught with shortages. You're still waiting 2 years for planes. These airlines keep buying more and more planes. The regional planes are usually Embraers. The longer distance planes are usually Airbus and Boeing. And these companies are companies that are still dealing with rapid inflation. And so I really like looking at the airlines for that, because I want to see inflation at some point roll over in the air business, like the aerospace business. But boy, we haven't been anywhere close to seeing that roll over yet. Payments on debt, look at this. They're really paying down their obligations here. And I like seeing this because the airlines have been so indebted. So not only are we paying down our air traffic liabilities much more than we were last year at this time. In fact, last year at this time they were growing, although that could also have been because there were fewer flights compared to now. Then you've got payments on debt. Finally, twice as much pay down now as you previously had. That's fantastic. So this already looks much stronger. Let's look at what we've got over here in ticket revenue. So we've got about an 18% increase in ticket for main cabin revenue, 25% increase in premium products. You are getting a lot of premiumization of the airlines as well. I personally wonder how that'll show up in inflation, because CPI generally compares the same pricing for the same product or service every year. So they'll make adjustments for, okay, is this a Granny Smith apple or is this a Gala apple? And their goal is to try to minimize substitutions. Of course, when they need to, they make substitutions. Point of that is, you're generally not going to see the Bureau of Labor Statistics take a main cabin seat and replace it with like a first class seat. But you might compare first class to first class on Delta and main cabin on Delta. But seeing more of a revenue bump in premium products is not a surprise for me at Delta, mostly because a lot of the companies are really trying to focus on giving more of these or having more first class availability. In fact, some of the newer planes are being considered as having substantially larger first class areas than main cabin areas, because people are just willing to pay more now, whether it's because the higher income individuals or middle to upper income individuals just have more money, or it's because people are just wanting to pay for more of an experience, or it's because people are tired of airlines getting so crammed and exhausting that they'll gladly pay for a little bit of a better experience. Who knows? 21% increase in loyalty travel awards. We've got their refinery business. So they actually also have stakes in oil and refining. The airlines use this as hedging. I always find that very interesting. Although refinery revenue is down 36%, it's actually very good usually when oil prices are down, because kerosene prices are down. It's a huge line item for these airlines. So this is more of a headline inflation figure to see fuel costs come down substantially. So we like to see that. Let's jump on over to the main page and see what kind of items they're specifically paying attention to. So they're saying Delta is delivering to customers with strong operational performance and best-in-class service during the busy summer period. With this performance, we generated record revenue and profitability in June. Our people are the best professionals in the industry, proud to recognize their achievements. We've got $666 million in the first half towards next year's profit sharing. Consumer demand for travel remains robust. Against this constructive backdrop, we are increasing our 2023 earnings guidance to $6 to $7 per share, reiterating our recently updated outlook of $3 billion of free cash flow for the year. This is pretty strong. It's a pretty strong report. The CEO has said in at some point here, either in this document or I was reading about this a little bit before it went live, that they are expecting to be in the middle innings of travel demand, which is quite interesting, because some folks were thinking that we might end up getting a rollover on travel demand, but it just seems like it keeps going. Delta's got 12 aircraft scheduled for delivery in 2027 and 8. They're looking for 12 more Airbuses, actually. They're trying to pay down $4 billion in debt, and they're really accelerating their debt repayment. This is what they're announcing. We saw that on the cash flow statement as well, though. You've got Delta Passenger revenue at 13.2 bill, exceeding expectations of 12.75. Adjusted revenue coming in at 12.61, exceeding the 14.4. You've got net at 1.72 bill, exceeding the 1.5 expected, and EPS of a midpoint sitting at $2.40 expected for Q3 adjusted. The market was only looking for 2.06. So these are really good numbers here coming out versus expectations. Let's look at some of the commentary on demand and outlook. And we'll get a lot more insight from the earnings call as well. But let's get started here. Robust demand is continuing in the September quarter, where we expect revenue to be similar to the June quarter, up 11% and 14% compared to the September quarter of 2022. Unit revenue strength continues. So really, what's remarkable about this, and it's probably going to help contribute to the market being at least somewhat happy here, is you've got more robust spending from the consumer, which is less recessionary. This is a broad leading indicator also of recession. If we were really heading into a recession, we shouldn't see a September quarter that is as strong as the June quarter. But in addition to that, we're seeing this coupled with less inflation. I mean, fuel costs down 34% versus 2022. Average fuel price of just $2.52 a gallon for kerosene, jet fuel. That's amazing. And listen to this. We expect in the September quarter non-fuel costs to decline 1 to 3%. So in other words, no recessionary indicator and even more fuel disinflation, actually deflation, quite frankly. Remember, disinflation is a lower rate of growth. Deflation is a decline in inflation. So more debt payoff, less recessionary indicator, less inflationary indicator. Couple this with what we've gotten from CPI. This is fantastic. This is a really good way to start off earnings season. I'm very excited about this. And even though I personally am not a big fan of investing in the airlines, mostly because I'm afraid of how much debt these companies have, they are turning this around. Looks like we've got about, I would say about $6 billion in cash and short-term investments. Looking at this quickly, I've only got about 30 seconds left to talk about Delta here. We've got current debts sitting at, current debts backing off loyalty programs and deferred revenues. We've got current debts sitting at about $25 billion in current debts. You've got long-term debts here in excess of at least $25 billion, again, taking out deferred revenues, probably closer to about $32 billion. Massive amounts of debt. Not extremely excited about this. But what I am excited about is you checking out those programs and building your wealth link down below, because we've got a massive coupon code linked down below expiring on the 26th Federal Reserve Day. And check out how you can bundle up to shadow me as well at meetkevin.com. Now, PPI expectation is 0.02. We are looking for core 0.2 headline and 0.1 for minus trade. Oh, we got a miss. Instead of 0.2, we get 0.1. Let's go. Instead of 0.2, we get a 0.1. And instead of 0.1, we actually do match. We get a 0.1. Final demand year over year. Oh my gosh. Instead of 0.4, we get 0.1 as well. All of these numbers are just absolutely a complete beat in the good direction, as in this is what we want. Let me reiterate this. This is insane. PPI final demand month over month was expected to be 0.2. We got half. We got 0.1. Final demand, X, food and energy. So in other words, the headline month over month number came in under expectations. The core number, X, food and energy, comes in under expectations at 0.1 versus 0.2. Then you get core, which is the refined core, food, energy, and trade excluded. You're at 0.1. And then you get year over year for the figure. Folks, the year over year number, it was supposed to be 0.4, basically flat. And we actually nearly get flat at 0.1. Oh my gosh. PPI X food and energy year over year. So this is your core, comes in at 2.4 versus 2.6. And then your refined core, where we also exclude trade, matches the 2.6 estimate, down from the prior of 2.8. This is phenomenal. This comes at the same time as Delta earnings are much better than expected. Not only are Delta earnings much better than expected, but we're seeing more gasoline disinflation combined with stronger growth expected for the next quarter. Now we get initial jobless claims at 237,000 versus the expectation of 250,000. In other words, less jobless claims than expected. And continuing claims came in a little bit hotter than expected at 1.729 million versus the 1.72 that was expected. But oh my gosh, these numbers are very good. Oh, oh my gosh, this just came through the tape as well. Oh my gosh, it just keeps getting better. Stop it. Stop it. This is ridiculous. Now the prior PPI numbers have been revised. The prior PPI month over month number was expected to be 0.3. What did we, a negative 0.3? We got negative 0.4. That's because we had this massive fuel decline. Then you have core month over month, excluding food and energy, that previously was expected to be 0.2, which has been revised down to 0.1. The X food, energy, and trade month over month number was 0.0, and they left it at 0.0. The final demand year over year number, although actually, no, I don't have that. I don't have a revision at all yet. So I'm assuming that's left at 0, but I'll let you know if that changes. PPI final demand year over year previously was 1.1. Now it's revised down to 0.9. Oh my Lord. Previous X food and energy year over year was 2.8, revised down to 2.6. Holy crap. In other words, this is fantastic. We started this day out saying, look, the worst thing that can happen right now is you not joining the programs on building your wealth and all of the course member live streams where we look at leading indicators all day long, every single day, or stock buy sell signals. Oh, sorry, that's not actually what I was supposed to say. I was supposed to say the worst thing going into today was a potential miss for PPI. Because if we missed PPI, PPI being a leading indicator for CPI, we would have literally undone what we got yesterday and crashed the market. We would have taken all the good news of yesterday and crashed the market with a bad PPI print this morning. But no, we didn't even just get a benign PPI report this morning. No. That's a scam. It's too good. We got a substantially better than expected PPI report with a completely revised lower previous PPI report. This is insane. Take a shot every time I say PPI. Okay, no, don't do that. Holy smokes. Let's look at some of the actual items here. So, okay, wow. This is absolutely incredible. So let's get into some detail here. So the index, the indexes for food and alcohol retailing, traveler accommodation, insurance, hospital and patient care, and airline passenger services moved higher. Conversely, prices for truck transportation and freight declined 2.1%. The indices for food and alcohol wholesaling and for residential real estate loans also fell. I mean, residential real estate loans, that's not a surprise. Your volumes in residential real estate are just complete trash because even though prices are up, it is very, 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 very difficult to get volume in real estate right now. So that is going to lower your potential here for strong earnings or strong fees at some of these mortgage providers, right? I mean, think about it. Mortgage providers are undercutting their fees just to get some food on the table. Just to give you a little bit more insight into that. I used to be a loan originator. Prices for final demand goods were unchanged in June after decreasing 1.6% in May. Final demand, an increase in the final demand for energy of 0.7% offset falling prices for final demand goods, less food and energy, which declined 0.2%. So in other words, continued goods deflation, actually. You have energy that actually popped up a little bit in this last month in the PPI report. And then you're still seeing the same area that you would expect be somewhat strong for producer prices, which is going to be your hospitality, your insurance services, and your travel services for airlines. This is somewhat expected. Again, the headline numbers all coming in way lower than expected. Looking for a little bit of reaction here from the suits as well. What I'd like to also get is a little bit more of a particular breakdown. We're going to get that in just a moment. But here's a comment already. PPI affirmed the messaging from yesterday's consumer report. Exactly. That's exactly what that's why I started this segment off today, this Meet Kevin report with, look, PPI could literally screw us today. Fortunately, didn't get screwed. Knock on wood. This is good. Okay. This is not how you would want to get screwed, even if you were inclined to be. PPI affirmed the messaging from yesterday, with headline and traditional core undershooting expectations. On the flip side, initial jobless claims did come in lower than expected, suggesting that any labor market deterioration is proceeding at a very gradual pace. That's a pretty happy backdrop for risky assets. Moderating inflation and moderate growth is about as Goldilocks as it gets these days. No kidding. Not only is it about as Goldilocks as it gets these days, but I'll tell you, and I'll do this while I'm pulling up the. I want to get a little bit more into some of the charts for this, but some of the bears yesterday were commenting that inflation overall seems to be getting substantially less sticky. I commented that it seems to me the bears are starting to capitulate, but I thought this was an interesting one. Now, I've made comments on macro wealth here before, and I was a little frustrated that I haven't really gotten response to some of the bearish charts that the individual has posted on Twitter, and I've reached out multiple times, but whatever. He's generally been very bearish and posted this: Powell's preferred inflation measure using core CPI services ex shelter. Here are the 3-month annualized rates. These are for consumer prices, not to be confused with the producer prices we're reviewing right now. But anyway, looking at this, what does he say? Well, he tells us that, okay, in January, we had a 4.1% level of a 3-month annualized inflation rate, which increased to 5.1, increased to 5.2 in March, decreased to 4.1 in April, decreased to 3.0 in May, decreased to just 1.4% in June, to where now he's making the argument that, quote, starts to look very unsticky to me. The last thing the bears had was that inflation would be sticky, forcing the Fed to continue crimping this economy and destroying what has proven to be the sexy Nike swoosh recovery that we've gotten in markets. And the Nike swoosh recovery has been so amazing. Some people have been sending me emails and letters going, Kevin, you got to stop calling it a Nike swoosh because Nike's going to get mad. And I'm like, bro, why would Nike be upset for being associated with deliciousness? And then they're like, well, the short sellers are going to get mad. And then I said, well, that's something everyone can get behind, isn't it? Anyway, so finance. You gotta try to have entertainment where you can. Okay, it's otherwise it's so final demand for goods. Let's look at just the right column here. Our seasonally adjusted May to June change, month over month. Final demand 0.1. It's nothing. All these people on yesterday tweeted that inflation is transitory, which we've been talking about for quite a while. But anyway, people got so mad at me. They're like, well, the grocery store disagrees. And I'm like, good Lord. Most people really still have this fundamental misunderstanding that inflation coming down does not mean prices are coming down. It's this complete disconnect from reality that actually makes me very happy because it means I get to buy stocks at lower prices. Well, people actually still think inflation is a problem. Whatever. Final demand for foods is actually deflationary here via PPI at negative 0.1. Let's look at some of the more headline characteristics here without going too deep. Household furniture, 0.2. Okay, let's just point out some of the items here. Tires, negative 0.3. Thank God. Cosmetics, still hot. 0.4 on cosmetics. Ulta's just been a stock that's been killing it. I wonder if they still are. Oh, yeah. Ulta at 484. They've had this crazy trading range, though. Look at this. This is like a beautiful trading range. It's a really wide wedge, is what I've been defining it as. Look at this rejection and then the bounce. I mean, it's almost perfect, this trade range that we've got for Ulta. And it looks pretty sexy right now. And seeing that over here on PPI potentially indicates some leading pricing power there at Ulta. It's been one that I keep looking at. I'm like, this has got to roll over at some point. Hot off the press, SEC sues Celsius. Oh yeah, more crypto lawsuits, baby. That's ridiculous. We just need some rules from Congress, but they don't even know what they're doing. It's ridiculous. They didn't know what they were doing during COVID either. We all knew that. Who were tracking Congress every day. It was ridiculous. Look at this. Electronic computers and computer equipment down again, 1.6%. It's not so great for indicating some leading surge from AI here. That's potentially actually a little bit of a leading downside indicator. I would have thought I would have seen at least some kind of strengthening versus the previous numbers, but no, not getting that at all in the technology segment. X-ray equipment, 0. Oil and gas machinery, 0. Floor coverings, negative. Commercial furniture, negative. Household appliances, these are your durables. This is nothing. Passenger cars, down 0.7%. Lawn and garden equipment and tractors, down. As your John Deere, basically. Look at all these zeros here. I mean, this is just beautiful. Aircraft, what did I tell you? One of the places you have remaining inflation is aircrafts. Aerospace is very difficult. That is one of the last holdouts for inflation. It's incredible. So then we've got mobile homes. Oh my gosh, who cares? 0.2. Railroad equipment, toys, games, and children vehicles, sporting and athletic goods. Okay, medical, surgical devices, those are all 0. Medical, surgical, and personal aid devices, 0.8. Yikes. A little hot over here, although the weight on this is, I believe, relatively small. Let me see if I can get the weight. Group code, item code. We don't actually have a weight listed on this. Probably very small, though. Final demand services. This is where you do not want to see escaping inflation. What do we have over here? 0.2 for final demand services. Fantastic. Really, really good. This is despite food and alcohol retailing up 2.3%, offset by 2.3% to the downside for food and alcohol wholesaling. And apparel wholesaling is down. Okay, look at that. Computer hardware, software, supplies retailing, down almost a full percentage point in just a month, folks. RVs up, though. That might not be a surprising summer expense. I think a lot of people are taking money out of home equity lines of credit, and they're jumping into, whatever they want, whether that's, buying travel, paying down other debt and consolidating more expensive debt, or potentially RV travel. So look at maybe some of the stocks like Winnebago to see if we can get some leading indicators from them on what's happening going forward with the market. Winnebago reports next. Oh, what do they report next? Oh, I don't know. That's a little bit difficult to figure out right now. That's WGO. Okay, we can figure this out. Hold on. Looking at another comment here from the suits. If yesterday's CPI data caused traders to all but eliminate the probability of a second rate hike after July, today's data may cause them to bring forward cuts. But assets seem reluctant to move much. Maybe there just isn't much further to fall after the July 26th FOMC meeting in terms of how long we're going to stay high with rate expectations. PPI surprised, obviously, all over. Okay, WGO for Winnebago. The next earnings set for Winnebago, which is a section we're seeing some potential inflation here, is June 21st, which just happened. And then you have October 17th. So that's if you're looking at Winnebago. If you're looking for Ulta, which could be a pretty big catalyst, especially for them, especially since you're seeing such a move in PPI for cosmetics. The next Ulta report is August 24th. All right, continuing. Final demand, transportation warehousing, negative 0.9. It's fantastic. I'm really honestly just going to start looking for the problem ones here because everything's just down. Airline passenger services. I was expecting this to be up yesterday in CPI. It was negative in CPI, air traffic revenue or air ticket revenue. Maybe you'll get a little bit of a bump here because of a PPI leading a 1.1% bump. Wouldn't surprise me, since I do think there's a chance you're going to get a core services bump for July and August because of probably hotter travel than the seasonal adjustment will take care of. All right. Application software publishing, 0.8%. Wonder what this has to do with AI. Pay attention to that. All right. What else do we have here? Negative 0.27 in consumer loans. Deposit services up 5.4%. Oh, getting a little more expensive to handle your banking. Property and casualty insurance. This is a problem. Full 2 percentage point bump here, and it's been hot. So insurance is still running up. It's likely, though, insurance is a very lagging indicator, because think about it. You would see your goods prices go up. Then you would see your construction services prices go up. And only after those things go up are you going to see insurance services go up. And those items, goods and services, could actually be coming down. And you'll still see insurance services going up because they are adjusting to a new reality of a lot more expenses. And this happens with a lag. Obviously, insurance companies are going to try to price this in as much as they can up front, but you also have to wait for renewals. You can't just call everybody up and go, all your rates are going up today. You have to wait for the contracts to renew. Yeah, not great. All right. Not great, but explainable. We'll put it that way. Travel accommodation services up 2.3%. Yeah, I think you're going to get a core boost in CPI next month because of travel. I'm not going to hold my breath on a for sure miss on the next one. But this so far is fan-freaking-tastic. This is very good. Here's some of your energy products, almost all negative. Organic compounds negative. Some of these other byproducts of oil production. Paper up 0.4%. Yeah, but this is actually the lowest increase that you've had in the past few months. You've had substantially higher increases over here. Okay, so that's actually a slowdown. Good. What else? Let me see what else we have, and then I want to get into some more commentary on these numbers here. We're getting into some more of the raw building materials here. Looking across, but look at that. Services for intermediate demand, 0. Flat. No inflation. How is the postal service coming up as 0? They just raised what's it called? Stamp prices. Advertising sales, 0. This is despite the fact that Trade Desk just hit a 52-week high. I've got some personal exposure to Trade Desk. Wow. It's just, I was not expecting Trade Desk to rip like that. But I like the exposure I have to it. Do like Trade Desk. I like Trade Desk, but wasn't expecting that rip. Wow. Okay. All right. The rest goes on. What else do we have here? Non-residential management fees for commercial property management, fine. Staffing fees. Just trying to see if I could get anything to really tell me I'm looking at something scary here, even in services. And I'm just not seeing it. It's either in lagging segments or, or travel here. Airline passenger services. That one's hot. It's there and it's in insurance, but otherwise we're broadly negative. So this is fantastic. I'm going to look for a little bit more commentary from Wall Street here. So, okay, this is great. Let me see if I got any other revisions in the economic data. No, everything's a miss the way we read it off. So rewind if you missed that. Okay, so that's really good. Okay, U.S. producer prices rise at the slowest pace in nearly 3 years, extending a months-long decel in pipeline inflationary pressures. Wow. Normalizing global supply chains, stabilizing commodity prices, and a broader shift in consumer demand towards services away from goods have generally helped alleviate inflationary pressure at the producer level. Services costs edged higher despite a sharp decline in transportation and warehousing costs. Right, we just went through specifically which. Some of those insurance, some of the airline travel, but then also software development, but not in the computer products. Software. Prices of goods, meanwhile, little change. That's flowed through to consumers in the form of lower prices, known as deflation. Imagine that. Excluding the volatile food and energy components, core PCE barely rose. And we saw that. These are Jerome Powell is going to get his monument for sticking a soft landing here. Figures come out just a day after consumer prices rose at the slowest pace since 2021. While a July hike is all but assured, the rapid descent in price growth, now just a third of its 2022 peak rate, offered fresh hope that the Fed can soon wrap up the most aggressive tightening campaign in decades. No kidding. Let's do our favorite analysis now. And let's look at the 5-year break. When is too much deflation a problem? Oh, don't worry. Don't worry. Do not fall into the bear trap of suggesting we're going to have a deflationary problem. We will print our way out of deflation. I promise. We will print our way out of deflation. And then people are going to go, wait a minute, it shouldn't be like this. It's all rigged. Maybe it is, but you got to learn how to play the game. And the game is they're going to print money. And if it doesn't cause inflation because we're actually avoiding deflation, so be it. At some point, all currencies collapse. The dollar will be no different. At some point, the dollar will collapse. But knock on wood, that time is no time soon. 5-year break even, actually sitting up a little bit at 2.19. It's quite interesting. Fed terminal rate expectations after PPI and CPI now sitting at, drum roll, 5.3375, basically fully pricing in one more rate hike and nothing thereafter. If we look at the futures rate monitor tool, we are looking at a Fed meeting in 1 week, 6 days, and 5 hours. That does align with the expiration of Meet Kevin's coupon code, which you can now use if you're a course member to get a pretty big discount on shadowing with me as well. I expect shadowing probably for nearly the rest of the year to be booked out within the next 2 weeks, if not before that. So check that out at meetkevin.com. You basically get tiered discounts based on how many courses you have. So the more of a bundled up course member you are, the more of a discount you get for shadowing. Yeah, it's a big benefit to existing course members. As always, I try to add more benefits to existing course members as prices go up over time. They lock in their prices and value, and the same could be true for you if you join before the next price increase. On July 26th, we're sitting at a 91.8% likelihood of a 25 BP hike with an 81.7% chance we are going to stay there by September. We are looking for our first cuts by about March, with an over 72% chance that we have at least one cut in March 2020. This is phenomenal. Absolutely great news. Also, by the way, interested to have anybody on Twitter Spaces chat in if you'd like to jump in on Twitter Spaces. We're now streaming on Twitch, Twitter Spaces. We're also streaming on Twitter via live video. So if you want live video, or you want Twitter Spaces, you can join, which is phenomenal. Actually, a lot of that is thanks to StreamYard. If you have not yet checked out StreamYard, make sure you go to metkevin.com/StreamYard. Allows me to multi-stream to different platforms at the same time, as well as throw out comments up on screen. Some of these we'll talk about a little bit later. Don't hate the player, hate the game. There you go. Exactly. The Prepper Ninja nails it. Absolutely right. So that does it for PPI. Absolutely phenomenal. Now, we do have some other things to cover. It's down here, though. Wow. Okay. All right. All right. Okay. I need to talk about this. Wow, I'm actually blown away. Okay. All right. Oh, no way. Cars for Coins coming. Dude, you're coming in right away. Before I talk about my next segment, what's up, dude? And you are coming in as a speaker right now, dude. Welcome aboard, man. You are in my streams like every freaking day, man. And I know you're the guy who sold Bitcoin, or no, you sold your car at 19,000 on Bitcoin or whatever to YOLO it into Bitcoin. What's up, man? Welcome aboard. Okay, waiting for your mic. I'll give you a chance to set that up. But There we go.
Yeah,
I think I
Kevin,
hear
I'm
you
trying not to crash my car.
now. Hey, what's up, man? Twitter Spaces and driving. At least I'm assuming you're on autopilot.
Oh, yeah. By autopilot, mean looking at my phone. No, Kevin, yes, I did sell my car for crypto, half Ethereum, half Bitcoin. I'm up 30%. So it was a 911 Turbo, so it's doing pretty well, up 30 grand. But,
Nice,
you
dude.
know, you're an amazing channel. You've kept me through the bear market, kept my head on straight, and kept me buying stuff. I went all in on Coinbase at $33. So sold all my
Wow.
ETFs and went all in. So that's doing pretty well.
Wow, congratulations. That's amazing.
But
So clearly very bullish on crypto then, despite all of the regulatory drama, eh? That this is maybe the beginning of the end for the regulation drama.
well, it's an asymmetrical bet, right? When
Mhm.
everything's low, the psychiatry tells you to sell. But if you're selling when everything's low, it stops it. So it's, am I bullish long term? Yes. I think anybody who has a long time frame wins. So
Yeah.
if you have a 2-3 year time frame, it lines up with both the rate cuts, which you just spoke about coming in March, and the
Yeah.
Bitcoin halving, which is in April. And typically the peak is 1 year after. So if your investment horizon expands to 2025 and you're buying crypto now, safe projects, I think you're going to do very well. But I want to ask you, Kevin, do you think the Fed actually pauses? I mean, continues pausing this time, continues at the same rates, or they actually raise like the market expects? Because they've been expecting, doing whatever the market expects so far, right?
Yeah, well, it's a little bit of a chicken or egg problem. I'll answer that. Let me first say regarding your alignment, I think that's a phenomenal statement that you made. This idea of, I mean, think about an alignment of a low rate environment potentially again. In other words, rate cuts, inflation being gone, probably the economy not being in a recession, the Bitcoin halving, and maybe 2023 is the year of regulation hell. But maybe they finally figure it out. And by 2024, you get crypto ETFs, you get regulation, and you actually get these companies that are able to recover. So I think you're completely right. I think that is a phenomenal argument to make. And I think that's awesome that basically you were buying ETFs. And then at one point you decided, you know what, this is my time to strike, and you dumped those and you bought crypto. So congratulations. Regarding the Fed, so I call it a chicken or egg problem because as much as the Fed likes to say, oh, we just do what the market projects, we just like to follow the market. We don't want to surprise the market. The Fed creates the market essentially. They forecast, hey, you know what? We might be thinking 2 more rate hikes. Well, what do they do by saying that? By saying 2 or more even rate hikes, like what Jerome Powell did in Portugal, you guarantee 1 more rate hike. And that, I think, is what they were trying to do. They were trying to say, look, we went 25, or we went for a pause in June. We don't care that it is a historically stupid idea. I personally think this, to hike again after pausing. I think it's idiotic because you send this signal of the Fed being inconsistent or not, having this stop-start mentality. Their argument is, no, we're just trying to stretch out. That's the way they're selling it. We're trying to stretch out these rate hikes. Yeah, look, we're at like a 90% chance of getting this 25. After these 2 reports, we're still getting a reiteration from, well, at least yesterday. After all the Fed speak yesterday, after CPI, we're still getting a reiteration of the 25. So we're going to get the 25, but it will almost certainly be the last rate hike after the reports that we've gotten. So yeah, I do think we're still going to get the 25, even though I disagree with it, even though I think it's nonsense. We're going to get it.
Well, Kevin, you say half the inflation battle is managing expectations, right? So that's exactly what they're doing. They're managing expectations. They don't like your Nike swoosh recovery. They don't like these meme coins popping off like Pepe, which I do not recommend. But that's exactly what they're doing. They're just managing expectations. They want to keep things cool. They don't want to, mess up their whole plan. Because if expectations get out of hand, people are like, okay, we're done. Let's all go in. Let's all buy Lambos. Then they're going to go back and do the whole, they're going to have to rug pull us, like you say.
Yeah, it's actually very interesting. They are so every single time they speak, they talk about how their biggest priority is making sure inflation is getting down, that too many people are hurting. And what they're doing by saying this is they're not actually talking to us in finance. They're talking to the regular American who's like, dude, everything is more expensive. Cheesecake Factory, the grocery store, everything's more expensive. The regular American doesn't understand disinflation versus deflation versus inflation. They don't understand that stuff. And that's fine. Let people be fearful. It makes it cheaper for us to buy the stocks we like, okay? It's just the way it is. Now, our schools don't educate people in finance. It's bad. We should, but we don't. So anyway, so you've got most people who are completely clueless about this stuff. And you have a Fed that creates headlines almost every single time they have these rounds of Fed speak going, we're going to get inflation down. This is all we're going to do. We're going to keep going until we get it down. And really what they're doing is you're just massaging those expectations down. Because what they didn't do in the 70s was care about expectations. They didn't even pay attention to them until 1981, when they finally realized, and you can actually see this in transcript conversations amongst Fed members that, oh, wow, nothing we're doing is affecting expectations. Maybe that's why we still have inflation. And then it wasn't until you basically had Paul Volcker stand up and say, the number one enemy is inflation. We will crush inflation no matter what it takes. Now I'm going to align that with what I'm doing and raising rates. That's basically what the Fed is doing today. They're like, even though behind closed doors and to the finance folks, you know, they're like, this is great. Like, this is Goldilocks. This is fantastic. Inflation's going down. We might avoid a recession. This is great. Publicly, they need to put on the face of, we will not stop until the job is done. You know, even though we're basically there. This is all expectation massaging. So you're 100% right with what you're saying. You start getting, you know, like the more I hear people on social media leave me angry comments that are like, what do you mean, you know, inflation is getting better and it's transitory. Everything's still expensive. Well, first of all, we know they fundamentally misunderstand inflation. But second of all, that is good. The more you have people like that, the less they're doing what you said and going out buying Lambos and borrowing to spend all their stuff. And don't get me wrong, people are still spending like crazy. But you're 100% right with what you're saying.
You know what's interesting? Expectations is also like the main thing of normal human relationships. It just goes back to normal psychology. Like anytime you upset your wife or piss off a friend, it's all about expectations, managing expectations. You either tell them you're going to do something, you don't do it, or you mess up. It's like I said, it just goes back to mismanaging expectations. But if you don't mind, can we jump back to the compliance thing with regulatory, with crypto?
Yeah, please.
It really seems to me from everything I'm hearing is that the main person that's holding back from actually putting forward regulation is Gary Gensler. And if you listen very closely to what he said during that CNBC interview, that's pretty famous, and you've called him out for that also, I appreciate it, is the one little thing he said is Coinbase is doing too much. So Coinbase is doing more than just trading crypto. They want a custody. They want to, they have the staking services, and they have the futures market now, and they have all these products. And it seems like Gary's really frustrated and confused, or at least using that as a scapegoat to not provide regulation because they're doing so many different things. And actually, yesterday he went on some meeting and he's actually given some feedback about the ETFs, saying that people called him out, say, hey, you know, Coinbase is using, all these ETFs are using Coinbase for their, what is it, SAS? I'm not sure what that is. It's
it's like custody and everything, market making, custody. It's everything together.
Right. So he's saying that he doesn't trust Coinbase. He's saying that Coinbase is basically going to trade against you on the back end, and they're going to mess with you, and it's going to be bad for the consumer. So that's what he's saying. Meanwhile, a 2x leverage ETF is approved. Does that make sense, Kevin? So is leverage safer than a spot ETF? Not really.
No, you're right. So to break it down a little bit, what you have with Coinbase, with the leveraged ETFs, is you have futures ETFs that are leveraged, that are approved, and futures are really contracts. They're not actually Bitcoin. They're just papers. Like, you have to kind of think about it as like, hey, I'm sitting down, I make a handshake deal with you, and let's go trade this contract. Futures contracts have existed for everything, and there's a pretty clear path to getting those approved and then getting leveraged versions of those. When it comes to what you're talking about with Coinbase, it actually makes me think that it's entirely possible that if we get into this bull cycle here, you could actually see Coinbase end up having multiple mini IPOs, basically splitting the business into multiple different things. Think about how the main like the traditional markets work today. You have an exchange, which I know initially when we hear exchange, it sounds complicated, but just think of an exchange as, like I always think of RuneScape. You go to the middle of the town square and you got a bunch of trading stalls and somebody's selling bread, and you walk up, you're like, yo, I want to buy some of your bread. How much is it? And you're like, oh, my bread's $5. And you're like, I'm going to walk over there and get the bread for, $4.90. I'm going to save myself 10 cents. That's a market. That's how we get price discovery, because we have individuals representing the market and participating in the market, participants. So we have an exchange, which, it's kind of like the vest I'm wearing here, the New York Stock Exchange. That's our traditional exchange. Then you've got market participants sitting on the floor. So floor brokers and market makers, they work price discovery. Then you have actual brokers who are like your Robinhood, that let you as a retail individual essentially get access to that marketplace, because you can't walk into that town square. You have to go through a broker. And basically what I've just shown you is 3 different levels here, right? The exchange, the market maker, price discovery, and then the broker. And then the brokers are custodying your assets as well. So you have these 3 different layers. With Coinbase, it's all in one. It's the exchange, the price discovery, and the broker all in one. And that's very different from traditional finance. And that leaves no precedent for the SEC and no rules from Congress. So you kind of have Gary Gensler, which obviously almost nobody in crypto likes, because, especially in that famous CNBC interview, he's talking about how, like, what do you mean digital dollar? We don't need that. We already have one, and it's called the dollar, right? That kind of makes people question his sincerity in general. Although I don't know if he meant to say that, but I mean, that's what he said. But anyway, look, it's going to be a rocky ride over the next year. I mean, we just heard about, what one of the executives over at Celsius getting arrested, and a new lawsuit against Celsius. So it'll be a lot of cleaning up. But once it's clean, it's going to be great for crypto once it's all cleaned up.
Kevin, do you think the dollar is competing with Bitcoin?
I probably it's interesting because they're, to some extent, both somewhat speculative assets. I don't think that somebody who looks at Bitcoin as a digital gold would ever invest in the dollar. So that's not somebody who is a competitor. Somebody who doesn't like digital dollars would invest not in the dollar. They'd invest in just gold probably. So I don't think you have competition there. You certainly have competition for trading and speculation. 100% you have that. As far as a means of exchange, you probably have little reason to use Bitcoin at this point, unless you're using it as for an international means of exchange. And really, I'd say most of the speculation in the dollar today is based on how high rates will be. And given that we've had these 2-week inflation reports, you're seeing the dollar get piled on in terms of a short. The dollar really peaked around actually about a year from now, when inflation was at peak, because people thought rates would stay high for long. The higher rates are, the more people are attracted to buying our treasury bonds, because it's the safest instrument in the world, deemed risk-free, and people need to buy the dollar to be able to get access to those treasuries. So I think you have a lot of different competing purposes for the different assets. In fact, you have almost an opposite purpose to buy Bitcoin versus the dollar. Like, you go long Bitcoin when you short the dollar. So I suppose that would be an interesting way to maybe say there's some competition, but they're certainly not competing for the same thing. In that regard, because again, as rates fall, risk assets are going to go up, which is great for crypto, and the dollar is going to go down because yields are going down. So probably too hard to compare on a direct level. But look, if we just step back for a moment and say, is there a competition between the dollar and Bitcoin? I think when we look at it from the SEC level, yes, absolutely. Because that's where you literally had Gary Gensler say, what do we need basically digital currency for? We have digital currency. It's called the dollar, right? So on that level, there is.
I'd say that's where him and you are, I don't want to say you're wrong, but there's a common misconception that Bitcoin wants to be a digital currency. First of all, it's not fast enough. Second of all, it's way too volatile. So I'm not going to hold Bitcoin in my business bank account and have employees to pay an overhead. So the whole idea that we don't need a digital currency, we have digital dollar, it just really pisses me off. I apologize for my.
No, you should be pissed. And whether or not Bitcoin is seen as that actual digital currency replacement. I agree with you. That's not really the argument. I think more the argument is like, why is Gary saying that, right? Like, what really, why does he get to decide what really should be up to Congress, and Congress should be deciding and regulating what the people want. If people want different options for digital assets, then Congress should create a framework for that. It's really just Congress that's way behind here. Congress is ultimately the group or the institution that decides this. It's not going to be some judge that somehow magically figures out that digital assets belong and how to regulate them. Although that's just what the SEC is backed into because of all the fraud that's occurred. So they have to file these lawsuits to try to squeeze the industry to mitigate fraud, and then hopefully spur Congress to regulate. That's at least my thesis on what's going on. But I agree with you on 2024.
There are laws in queue. The Toomey, I think Pat Toomey and some other Loomis are working on bills that are already presented, and they're still working on them. But to go back, just one more thing. From my experience, we have sold cars for crypto in the bull market. Right now, nobody's doing that. They're selling cars. But what really happens in the functional usage of crypto is people speculate on Bitcoin. So they'll use the dollars to buy Bitcoin. They'll use the dollars to buy Ethereum and, more risky, low cap coins. And then they're going to cash out into USDC, which is a Circle product, also heavily tied to Coinbase. So for me, I see USDC as the digital currency that's competing with the dollar that can actually become a CBDC in the future. And that's built on Ethereum, why I love Ethereum. So practically speaking, to say that we don't need a digital dollar is competing with Bitcoin, is just crazy.
I agree.
Like I said, you buy very, very speculative, highly volatile Bitcoin so that with dollars, so they can later put into USDC, and then you can send it overseas or buy a car or whatever with it. And that's the actual practical use of crypto, is that you're putting into stable coins. So number one has got to start with stablecoin regulation, which is the first step. If I'm holding USDC, like my plan, 2025, I'm cashing out 90% into USDC, paying my taxes, long-term capital gains, and then I'm going to go back in when it crashes by 50, 60% again, 26, and retire in 2030. But like you said, it starts with regulation, and that's what Coinbase wants, and eventually they're going to get it. And it's going to be a beautiful thing. So I appreciate your time, Kevin. Thank you.
Yeah, absolutely. And I completely agree with you, by the way. I'm a big fan of stablecoins to the extent that they have transparency. And I think that's what regulation will bring, because right now, we don't know still today how, obviously we've seen the ramifications of it, but the amount of leverage on the CBDCs, not the CBDCs because we don't have those yet, on stablecoins is obviously an issue. This is where we get the rehypothecation that took down BlockFi and Voyager, which was literally what we had the CEOs on. And I asked them about it. I go, there's got to be so much risk in these stablecoins. Like, I'm personally still so frustrated. I'm looking back and give us transparency of the stablecoins.
Right.
Like, I want to like stablecoins, but there's no way you're offering 9% without all this crazy rehypothecation. They're like, don't worry, we have safeguards in place. Yeah. Oops. Just give it all to Three Arrows Capital was the safeguard.
Trust me, bro.
So yeah,
Trust me, bro.
True transparency there in a real functional stablecoin. I'm all in.
Yep. And no, I don't trust Tether, just for the record.
Nice. That's awesome. Dude, this has been amazing. Thank you so much, man.
Thank you, Kevin. I'll hop on anytime you want. Thank you.
Thanks. Yep. All right, let's jump on over to the next segment. That was really fun. I like incorporating Twitter Spaces here. Shout out to Car for Coins regularly here supporting the channel. So big fan. So I'm a big fan of Car for Coin. I want to clarify that. It's very cool to see someone so supportive, and very good insights, by the way. Very, very impressive. Okay, so let's now get into. I was really surprised with the response here from yesterday's. I was honestly blown away by this. Hold on, we're gonna look about this really quick. Okay, yeah, here we go. Okay. Okay, right. All right, here we go. All right, next segment. I'm blown away. Yesterday, I made a video that honestly I thought was going to get like 2,000 views. I did not think this video was going to do well, but I wanted to cover it because I thought it was really important to address the potential disaster that's happening at UPS. And even though I initially dismissed it, I realized my mistake that this is not something that we should be dismissing. We should be paying attention to what's going on at UPS. Because even though technically we're in a freight recession and freight volumes and package and parcel volumes are plummeting, revenues aren't really plummeting at companies like UPS. And UPS's margins are still doing pretty dang well. Despite this, you have UPS walking away from negotiations with arguably one of the largest unions, actually probably the largest union in freight, and a very, very large union of almost, 1/3 of a million individuals. It's remarkable. And yesterday in the video where we talked about this potential for an inflationary spike due to a UPS strike, think about it, snarled supply chains, delayed inventory accrual, meaning potentially higher prices for goods and services again, as people are now creating, or as businesses and individuals are creating wait times again. This could be a disaster. I mean, even just the threat of a strike could lead to more ordering and individuals basically stocking up earlier again, potentially driving up temporarily at least CPI and PPI in future months, because people potentially are worried that somebody who handles somewhere around 37% of shipments, UPS, which company, not somebody, it might completely shut down historically for as long as maybe 2.5 weeks, likely for potentially up to a week before UPS realizes they need to negotiate with the Teamsters Union. But what I wanted to say, what I was blown away by, well, I guess I should say before what I was blown away by, is I want to give you a quick reiteration as well, that in addition to going through the earnings at UPS, I actually think it's very, very important that UPS make sure they deal with this. It will probably, my expectation, get dealt with before the end of the month. I think that would be very smart. I think the 28th is probably a good target. That would be a Friday, right? I think that's a Friday, before the 29th and 30th. The 31st, I think, is a Monday. That'd be a really good last opportunity to get this done. And it would be nice to make sure there is no shutdown. But what was mind-blowing was I went into that video yesterday knowing that 97% of Teamsters unions were for this strike. But I was more mind-blown by the support this video got. I, again, thought this video was going to get like 1,000 views. And like it was going to be super niche and super small of a topic. But no, it was the best performing video I posted yesterday with over 70,000 views in just a matter of hours. And I'm going to look at some of the commentary here. Look at some of what we got. This is incredible. I worked with them during the holidays. The drivers get a great deal. They earn it though. Running up and down 100+ driveways and steps every day except Sundays. Planning and consolidating all your packages for efficiency and doing it safely. It made me a better driver. They do so many details Amazon doesn't. UPS workers, well, I'm going to heart this. UPS, and I really want to dive into some of the reactions here and see what we're getting, if we can glean any insights. UPS workers will never go work for Amazon. It's a massive downgrade in pay and benefits if you actually look at the details. This is amazing. I mean, I'm not in the freight industry, but clearly there's a big difference between the professionalism that you get at UPS and Amazon, from what we're getting from the comments here. And you kind of see this too. So, but let's just leave that there. All right. So nobody from UPS is going to work for Amazon. They'll have to take a 50% pay cut, which, I will say this is actually an interesting argument. Like, wait a minute. On one hand, the UPS union is saying we need more pay. But then on the other hand, we're saying, yeah, but the competition is paying way less. So I think that's probably an argument that doesn't bode too well for the UPS unions, that the competition is paying way less. Probably doesn't support their argument. But I will say, I mean, we've got a UPS guy that's been servicing us for like, I don't know, a decade now, it feels like. It's been 8 years that we've been here. His name is Brian. This guy's amazing. I mean, he tells me about his retirement, how he loves working for the company. Maybe not recently with this threat of strike going on. I should talk to him again when I see him. Actually, I got a UPS scheduled for delivery today. See, and I wouldn't be getting that if there were a strike. Oh, didn't even think about that. They're like, this is personally going to affect us too, right? But anyway, he's got 2 kids. I bet he had 2 kids. He might have had a third now, but he's one of the happiest guys I've ever seen. I think one of the reasons he's so happy is because he legitimately loves his job. And if anybody's like Brian at UPS, it must ordinarily be a great place to work. Somebody here says, I worked for UPS for 11 years. There was a strike threat basically every time there was a new contract coming up. The drivers make very good wages once they hit full scale. The benefits are basically the gold standard there too, even for part-timers. Highly doubt anyone moved to Amazon. Wow. 0 AC working in 100-degree trailers loading by hand. Oh, at Amazon. Yikes. Talk to a UPS worker, and he says the air condition is like a bandage. He's ready to go on strike. Okay, interesting. I work for UPS. No one will leave if the strike goes on long enough. They'll just work and get shunned by everyone striking. Looking forward to the strike. Let's go. Interesting. Not overstaffed. All UPS drivers are complaining about excessive forced overtime, especially in this heat. Now, this is actually really interesting. I didn't know this. And, obviously this comment's getting a lot of attention here. I was under the impression that if freight volumes were declining, that it'd be possible that you'd have too much staff. But it appears that's wrong. Okay, good to know. As a current employee, I agree with Kevin when he says the strike will be short. The staffing comment is off, though. The summer isn't friendly, so we will get a lot of quits, and management claims we are understaffed. Interesting. So you get a lot of quits in the summer. That's very interesting. This is very insightful. This gives, really very functional commentary here. So I see them driving with the doors open. AC must not be a benefit for them. I think that's honestly an efficiency thing. Imagine you have to open the door every single time to get in and out. I'm not sure about that. Back in Florida, back when you drive around a convertible on a hot day, I found you would actually have to blast the AC with the top open of the convertible just to enjoy it because it's so hot that you have to have the AC on and the top down. But really, the support here is absolutely incredible. Now, what I'm going to do is I'm going to look at some more news that we have here. We need some more strikes to get companies to learn. Vanguard owns 9% of UPS. Wage price spiral coming. All unions getting 20% wages this year. Some of that could be lagging, though. Ryan Reynolds, I love your show. Okay. All right. So what are some of the latest updates that we have here before we get over to the Course Member Live? Just remember to join that. We've got an expiring coupon code in about 1 week and 6 days for the Fed meeting. We'll have an expiration there. And email us at staff@meetkevin.com if you have questions on those, or just go to meetkevin.com to learn more. So the wider variety of alternative carriers today versus 1997, the last time UPS Teamsters went on strike, and softer delivery demand are key reasons why this strike is possible. See, that's interesting. This aligns more with my original argument that I think there's potentially, if you have less demand for parcels, then potentially that could lead to more of an aggressiveness from UPS. As a result, shippers have less of an appetite to accept aggressive rate hikes. Well, obviously, workers would probably argue that they're not aggressive rate hikes. But anyway, this is from UPS. Oh, interesting. So there's this argument here that maybe people who are shipping are less interested in paying higher fees for UPS. But then again, you look at the revenues; they're through the roof, despite the decline in actual parcel numbers. Yeah, UPS has no rate increase to announce, a spokesperson said. The carrier periodically evaluates its prices to ensure they reflect the value they provide. UPS and FedEx and other carriers typically announce annual rate increases in the second half of the calendar year. Last year, 6.9% increase from UPS cited the need to support ongoing expansion and enhance its capabilities as reasons for its implementation of the price hike. The one thing we do know is that rates will go up at some point in the future, but how much of that is due to giving up or giving in with the Teamsters is anyone's guess. They have to remain competitive. Remains to be seen how much wages will increase in the next contract. It looks like they're also hitting roadblocks over specifically part-time pay. Yeah, however, it does look like the conclusions we're getting here, at least from Wall Street, are that UPS employers are poised to see higher wages. So there's going to be some kind of win coming here. FedEx and others would capitalize on higher rates. One factor limiting how much UPS can raise rates is its competitor, FedEx. two delivery giants consistently stay in lockstep with each other. Although I will say, UPS, when we looked at the margin yesterday, had substantially better margins than FedEx. But it's not just then, it's also alternative parcel carriers like OnTrack and LSO. And then, of course, you've got Amazon. Okay, interesting. Weaker demand complicates price hikes. This is the weaker demand for the parcels. Makes sense. UPS demand cooling off after pandemic surge. The company's average daily volume by quarter. What's happened in the last year is carrier pricing power has diminished significantly, which means it's going to be harder for UPS to pass on the rate increases. And that's why they seem to be stuck with pressure for wage hikes while not being able to potentially pass those on, which means margins will get squeezed. But then again, margins are already so good. All right, so that gives us a little bit more here. Here's a USA Today piece that argues, let's see here, what are they arguing? USA Today piece on this. UPS workers may go on strike, what it means for you. All right, let's see here. The last time they went on strike was 97. Consumers could face, let's see, small businesses struggle to restock their shelves, and hospitals had a hard time securing supplies, according to the NYT. Consumers could face that and more if this Teamsters Union goes on strike and they do not reach a deal by the end of the month. If a deal does occur, it will be very disruptive, says the Department for Supply Chain Management at Michigan State University. Consumers going to be more affected getting everyday products we buy online. That is an interesting thing. Back in 97, you didn't have what you had today, Amazon. And that's potentially going to make a strike even more disruptive this time around than ever before. That honestly gives the union a lot more bargaining power. But it's going to be a problem, because if there is a strike, it is going to affect inflation. And we don't want that. Like, we got good inflation reports here. Please, UPS. And, obviously it's a give and take, but both sides figure this out. Nobody wants to go on strike. But I understand people will. If a strike does take place, it would be the largest strike in employer history. Wow. That's actually incredible. Largest strike in U.S. history, that is. Even a short-lived strike could have huge impacts for consumers. I agree with that. They have a large network. Taking the kind of capacity out of the market, even for a day, will have ripple effects at nearly 25 million packages daily. Longer wait times are expected during the strike as shipping centers like FedEx and the USPS deal with an influx of packages to try to make up the volumes. And there's no way they're going to be able to make that up. FedEx will prioritize existing customers while trying to get people to switch, of course. Supply chain disruptors, spare parts for motor vehicles. And this is already where we're getting inflationary concerns, right? You have inflationary concerns at in insurance services, in motor vehicle services. Not good. These are places you already have inflationary concerns, and they could get even worse. Healthcare supply chain could take a hit, since wholesale companies that manufacture medical devices and supplies rely heavily on companies like UPS. Other industries with dealers that rely on getting spare parts from wholesalers via UPS, including farming and construction. And that's another thing. It's the construction industry. It's just absolutely blowing up right now because the home builders have such big PP, because there's so little inventory for housing. The home builders have so much pricing power, PP, that last thing you want is shorter delivery time frames on construction material. I did just post a link for course members for the live stream. Sorry, we are going to just do the bell here really quickly. Usually we have a tradition of doing the bell together with course members. So we'll get the bell together here.
Let's get the opening bell here.
I need to keep talking about this inflation for just a moment. We'll start with a story, but quickly, let's hit the bell together here.
A ride-hailing app in Turkey celebrating a recent listing via SPAC at the NASDAQ. Abacus Life, a buyer of life insurance policies, recently listed via...
Sorry, out of tradition, we like to do the bell together. Every day, I really enjoy doing the bell. Generally do it with course members, but I just have to keep talking about this UPS issue because it's actually a big deal. I want to give this example. I spoke with I bought this computer from this company called iBuyPower, and first of all, never buy from them. Their customer service was like outright rude to me. I paid for rush production on July 1st, and they're like, cool, we'll ship your product out by the 6th. And I'm like, really? paying $200 for rush production or whatever it was, $100 to $200. Rush production, it's going to take until July 6th. Like, I get it. There's July 4th, but that's one day. Anyway, so that was lame. But then they're like, oh, we'll overnight it. And I'm like, okay, fine. If you overnight it on Thursday, it'll show up on Friday. But they didn't get it out until Friday. And then they overnight it. And they're like, oh, well, we don't mean weekend overnight. We mean business day overnight. And then it's supposed to show up on Monday, this Monday, just, 3 or 4 days ago. But it doesn't show up on Monday because it gets delayed because they got it to FedEx, the carrier, too late. And then, so then it doesn't show up until Tuesday. But the point is, like, we had, like, a lot of things lined up in the business. So from like a personal anecdotal level, we're like, we really wanted that computer. That's why we paid for a rush for it. And like, that's just one box. UPS is delivering 25 million a day. And everyone's stuff is just as important as somebody else's, with the exception, obviously, of like hospitals. We could probably say they're a little bit more important. But anyway, other industries with dealers that rely on getting spare parts from wholesalers via UPS, including farming and construction. Consumers are not going to be the only ones. It's a new shock to the supply chain. This is literally the last thing we want. Please, we want inflation to stay good. Don't ruin it, UPS. A strike could also raise the cost of shipping, even if delivery companies don't increase their rates amid a stoppage. UPS customers may need to turn to higher-priced alternatives from a competitor or pay for expedited shipping elsewhere. Didn't even think about that. I mean, think about it. If you're like, okay, my stuff is sitting at the UPS store, it's not getting picked up, I'm going to take my box back. Now I lost a day or two. Now I have to pay for overnight, where ordinarily I could have just paid for ground at another service provider to get my product where I need on time. That's not great. It increases your producer costs, hits margins. It's just not good. A strike could also raise the cost of ship. Right, we talked about that. This is actually a good piece by the USA Today. It may not be an immediate change in prices, but it is maybe leaning into some direct payments for more expedited shipment, right? What can consumers do? Shop online, do it now. But honestly, even the recommendations to shop online now, it just basically accelerates the inflation and pricing pressure that you end up getting now. Other shoppers should consider shopping in person, which is also more expensive, and avoid or ordering pickup to avoid delivery delays, a feat that should be easier to accomplish amid warmer weather months. It's a blessing in disguise that this is happening in the summer. Well, maybe not for the drivers because you got to drive around in the heat. But this is intense. And what's remarkable is, at least what I'm seeing is, I'm seeing no progress on this. And I really hope we get more progress on this. But it doesn't look like it's coming yet. I want to take a peek at Barron's take on this. So the International Brotherhood Teamsters put out a statement saying UPS has walked away from talks. Right, that's what we talked about last video yesterday. I guess the actual average number of packages delivered per day is 24.3, a little less than that 25 I mentioned, just to get a little bit more exact. And again, mark your calendar for July 31st, because July 31st is when we need a deal by. If you go to Carrier, okay, well, that's actually a USA Today reprint. It's looking at the Carrier Journal. And I'm going to look at NPR's piece on it quickly. I know some people don't like NPR. Everything's getting so politicized these days. It's just freaking exhausting. But NPR does call them much more vulnerable in the event of a strike this time around to basically other companies taking over. Now, that's also a downside for both sides, right? Because you don't want UPS volumes to end up going somewhere else, because then you ultimately have less packages. So it's really important this just gets dealt with for both sides, the Teamsters and UPS, before the 31st, but also the entire economy. So please get it figured out. Anyway, thank you, everybody, so much for joining me on the Meet Kevin Report, episode 122. I've got to jump to the course member live stream. I'm already late. And quite frankly, I need to make another cup of coffee really quickly. So I will be there in about 3 to 4 minutes as soon as the coffee is done brewing. Thank you all so much. Please check out the courses if you like my perspectives. Link down